We'll start with cash flow analysis, especially AS number 3 as well as Ind AS number 7. There is no more differences between these two models. Now, cash flow statement presentation could be of two types. One is direct presentation, direct method. Another one is indirect method. Currently, indirect method is the requested method or recommended method. Mandatorily, you have to follow as per AS number 3 and Ind AS number 7's requirement. Is that okay? See, under direct method is nothing but a cash book, receipts and payment. You have to redraft this in a vertical format, but the items in the receipt side and payments are classifiable into three varieties. Cash received for your business operation, otherwise called as cash from operations. And for the investment purpose, you may either use the cash or by selling the investments, you may get the cash. That will be called as cash from investing. And for sourcing the fund requirement, capital or working capital, whatever it may be, cash from financing. So we have the three aspects here: cash from operations, cash from investing, and cash from financing. These three aspects we have. Clear? Once you understand the items meant for operations, investing, and financing, you can simply restate the cash book into the cash flow statement easily. Under indirect method, that cash from operations tail will be totally different. Rest will be the same. Rest will be the same. See, in your financial statement, in your balance sheet, cash, bank, and marketable securities. This will be called as cash. This will be called as cash. Other than that, others will be called as non-cash. If anything converted from non-cash to cash or cash to non-cash, then that's a flow and you present that in a cash flow statement format. Cash flow statement. Clear? Hope you will be now able to understand easily. In your balance sheet, non-current assets, current assets other than what? Cash. And another one being cash. Current liabilities and equity share capital, preference share capital, non-current liabilities, even accumulated profits and losses. Non-current, then current liabilities. Okay, this will be a separate thing. What's that? Cash is a separate one. So this will be cash. Cash here, not only cash, bank balance as well as marketable securities will also be forming part of cash. Okay. Now, though if it is being the marketable securities, the value is fluctuating amazingly or tremendous fluctuations there, then it will not be considered as current investment. You have to be careful here. By selling the asset, you will get the cash. By purchasing the asset, you need to apply the cash. Then there is a cash flow. And by issuing the shares, you will get cash, or by buyback, you have to pay the share, means share price back. Also applications. Okay. So you block the entire balance sheet into two blocks. From here to here or from there to here, any transaction happens, then it's called an item of cash flow statement. If the transaction happens within this, or this way, it's not considered as a cash flow statement, a part of item of cash flow statement. How this will happen within this are preference share capital may be converted into equity share capital. Convertible preference shares, sometimes stated. Preference shares may reduce and equity share capital may increase. And vice versa, debentures all. And within this, you could have sold the current assets, but in return, you don't get the cash, but you are getting in the form of debtors or stocks. So then also, it is not an item of cash flow statement. I need to know how I get the cash. I never bother about what's the profit you make. My intention is to find out cash earning power only. Now, usually you prepare in what angle? In cash book. What do you do? Receipts and payment. Opening balance, closing balance. And you write all the receipts here and all the payments here. Opening balance assumed to be 100, closing balance may be 150. So the cash balance increases from 50 to 150 due to some receipts and payments. The receipts could be now categorized into three different types of receipts, applicable payments also in the same three. Receipts and payment related to non-current assets and non-current liabilities and owners fund. And the receipts and payment due to current liabilities as well as current assets or working capital. Not only that, due to profit earned. Any cash you generated because of this reason is called cash from operation. Is that okay? Debtors converted into cash. So debtors decrease is nothing but receipt of cash. So whenever the current asset decreases, we assume it is converted into cash, the cash balance is increasing. It's a cash from operation item. Similarly, when the current liability increases, you might have paid, you might have, current liability increases, you could have borrowed, but the cash is with you only. Also, an item of cash flow, cash from operations. Now, what happens if the debtors and creditors mutually cancel? Intercompany owings, like we never bother about that because it's not affecting the cash. So, current asset increase and decrease will have the impact, as well as the item related to the profits. Always remember, profit will not be equal to the cash balance. If we make 100 rupees profit, not necessarily the same 100 being in the form of cash. Okay, purchases. 10 units at rupees 100 each, 1000. And sale. 8 units at the rate of rupees 110 or 120. How much is that? 960. 960. And sales being in the form of debtors, purchases being in the form of creditors. Purchases being in the form of creditors. Right. Otherwise, purchases may be in the form of cash. Now, what about the closing stock here? 2 units remains unsold. Its value being 200 subtracted, you have 800 rupees being the cost of goods sold. 160 is the net profit. If I ask you how much cash you have, to make the concept simpler, I make this also being cash. You received 960 because of the sale of the commodity. You paid around 1000 rupees for the purchases. There's a shortage of rupees 40. There's a shortage of rupees 40. Isn't it? You have put the money from your pocket. 1000 rupees you paid for the purchases, you sold for only 960. Absolute cash term, we have shortage of 40. But for the financial accounts purpose, as per accrual concept, the net profit being 160. What does it mean? Initially, we don't have the stock. Because of purchasing and sales, we had a sales stock of 2. 2 units costing 200 rupees. If the stock increases, we assume our cash is locked there. Find out the net profit as per the financial accounts, 160. Because of increase the stock, cash is locked out, or otherwise cash balances decreases minus increase in stock. Increase in stock being 200. If I subtract 40, will be the cash from operation, that too negative. Hope you'll be now able to understand this. From the net profit, do the adjustments for the current assets and current liabilities. And even sometimes the net profit will be not as per the regular cash balance due to some non-cash and non-trading items may be debited and credited. Those things are now excluded to get the answer. Hope you'll be now able to understand this one. This is simple logic. So whatever it may be, the ultimate cash you receive because of this component, changes in profit and loss as well as changes in working capital will be cash from operations. Then because of the asset, if there is any cash or if the cash is applied, then it will be due to cash from investing. You are making the investment, right? And for investments and operations requirement, you are in need of fund. You can raise a fund by issuing the shares and other thing. This will be called cash from financing. Cash from financing. Three aspects. So let's see. For the cash from operation, receipts being what? Collection from debtors. For cash from operation, payments being payment to creditors or some expenses also paid. This set will be for cash from operations. Cash from operations. Now, in case, if you sell the asset, decrease in non-current assets, where decrease in non-current assets realized in the form of cash. The decrease of non-current assets due to the depreciation may also be there. Because of the decrease in value of the assets due to depreciation will not have any cash impact. If you are selling and collecting the cash, it will have the impact in cash form. So it's a receipt side will be shown here. Increasing the non-current asset is nothing but purchases. Decrease and increase. This will be called as cash from investing. Not only that, now we are going to consider the next part. What's that? Financing. Increase in share capital as well as non-current liabilities sources. Decrease of share capital and non-current liabilities applications. This will be due to cash from financing. Ultimately, if you tally this, you started with the opening cash balance and end with closing balance. So it's very simple. The cash book is posted in vertical format. Not only in the vertical format, you are going to categorize the receipts and payment for operations, financing, and investing. So if you are able to show this way, then it's called cash flow statement and direct method. In case of indirect method, I will guide you later once we'll finish up the direct method, which is very rare for your examination, but of course for understanding purpose, you have to know that. In most of the cases, you will expect only indirect method. So we'll finish up this and we'll go for the indirect method later on. Now, see, practical problem. Cash flow statement. Prepare cash flow statement under direct method. Question number 1. From the following summary cash account of X Limited, prepare cash flow statement for the year ended 31st March 2021. In accordance with AS number 3 using direct method. Which method? Direct method. We have been given opening cash and closing cash. Come on. What about the classification of revenue, means cash received for issue of equity shares? Financing. Receipts from customers? Operations. Sale of fixed assets? Investing. Payment to suppliers? Operation. Purchase of fixed assets? Investing. Overhead expenses? Operation. Wages? Operation. Taxation? Again, operation in general. Okay, dividend. Why do you pay the dividend? You are paying the dividend for equity shares. Equity share is related to the financing, so this is also related to the financing. Repayment of bank loan, financing. Okay. Now, taxation. You can write that later on. So I'll start with this one. We'll start with the cash from operation. Cash from operation. Under cash from operations, we have receipts from customers. or collection from customers. This value being 2,800. Then payment to suppliers. Supplier 2000 negative. Overhead expenses 200 rupees negative. Wages and salary 100 negative. If you subtract all these things, you'll get 500 rupees. This is considered as cash from operation before tax. Minus tax paid. Tax paid here being 250. Then you'll get 250. This is nothing but cash from operation. The next one being cash from investing. Related to that, sale of fixed assets there. So sale of fixed asset. This value being 100. And purchase of fixed assets. Purchase of fixed assets. The value being 200 minus item. Only this one. So the ultimate value for the cash from investing being 100 negative. Actually, there is no source applied, fund applied. Then cash from financing. In case of cash from financing, we'll start with issue of equity shares, 50 rupees, 300 rupees, and dividend paid minus 50, repayment of bank loan minus 300. Now ultimate value here being minus 50 applied. Now find out total cash from operation, cash from investing, cash from financing. So 150 negative 250 positive ends with 100 rupees. With that, add opening cash balance. The opening cash balance is 50. Then finally you'll get closing cash balance. Closing cash balance. Hope you'll be now able to understand this one. Now, see, in case of taxation, if nothing stated is cash from operation activity where it's an outflow, cash from operation. Sometimes it may be related to the cash from investing also, cash from financing also, if there is any adjustment regarding this. In case of capital gain, you get the capital gain only because of selling the assets. Then tax will be on the capital gains because of sale of the assets. Assets related to the investment, then such capital gain tax will be considered as cash from investing. Similarly, while distributing the dividend, sometimes you have to pay the tax earlier. Currently, we don't have dividend distribution tax. Related to the distribution of dividend. Dividend is also financing, and the tax related to distributing the dividend is also financing. Hope you will be now able to understand this. Clear? Now, the most important thing is indirect method. So, under indirect method, how can we solve? Whenever any income statement is given, no. So, here income statement and balance sheet given. Question number 2, a comprehensive illustration. So, it's your duty to find out the prepare the cash flow statement indirect way. When the income statement is given, usually you don't take that. Okay. Only the required adjustment items will be taken from here. Before I go solving this, let me finish up the format here. Cash flow statement, first being cash from operation. Cash from operation. Okay. Cash from operation. And cash from investing, cash from financing. If you are adding the cash from operation, cash from investing, cash from financing, with that add the opening balance, then ultimate balance what you get here is closing cash balance. This one you know. Okay, decrease in non-current asset is cash from investing. Increase in non-current asset is applications of fund, outflow of cash. This is inflow, this is outflow. But because of that investment, you get the return on investment. Okay, also your inflow. And if you are making any tax payment for that, tax on this one, investment or capital gains tax. Okay. Okay, that will be tax on this. Okay, will be an outflow, can be subtracted here. Hope you'll be now able to understand this. Cash from investing, cash from investing. In case of cash from financing, increase of non-current liabilities along with the increase in shareholders' funds will be the inflow, and reverse case you might have settled, right? So it will be the outflow. It will be outflow. Clear? And dividend or any interest payable for the above two will be your outflow. Sometimes you need to pay the tax associated with this distribution, will also be outflow. Add up that. So this will be called cash from financing. Clear? In case of cash from operation, you start with collection from debtors and payment for creditors and expenses related to operation, cash expenses, operation related expenses, that too it should be in the form of cash. These two are subtracted. Then you will get cash from operation before tax, and you can pay the tax here. You'll get the cash from operation after tax. Hope you'll be now able to understand. This one is the direct method. Now we have to go for indirect method. This is the recommended method. Under indirect method, we are going to get the same cash from operation after tax from the net profit by doing the reverse calculations. Okay, net profit, what you get in the current year? Come on, tell me. In your P&L account, you might have debited and credited what? Some non-cash items as well as non-operating items. In your P&L account, you could have debited the depreciation, credited the revaluation profit, both. Because of these two reasons, cash has not gone out or not come in. So definitely there will be impact. If you are debiting the depreciation, profit may go down, but cash will not. So you have to add the non-cash expenses back. Non-cash expenses. The good example for this being depreciation. As you are adding this, what you have to subtract? Non-cash income should be subtracted. Minus. Okay, appreciation and depreciation. After this, non-cash income. Non-cash income. Apart from, you may debit some expenses are income not directly related to your operations. You may have, say, 5 lakhs rupees cash surplus during the collection period, supposed to be used when the cash drained position comes in the later on. So that time, that 5 lakhs can be used. So what we can do, rather than keeping in a bank account in savings bank, it could have been invested in short-term securities. For 3 months later, if I withdraw, then I will get interest. So the interest received from that is not my intention. The interest received from that is not my intention. Hope you will be able to understand. Receipt of interest is not my intention. But anyhow, I have the surplus resources. That resources can be temporarily used for generating income. But those things are not related to the operations. Cash is there, invested, revenue generated. Related to the investing, not here. Similarly, I may purchase a share, I may get the dividend temporarily. Temporarily, I may let out my property where it is not operated for some period. For additional resources, I am getting revenue. So those things are not my business operations intentional one. So in those cases, those things also be removed. Not only non-cash, sometimes non-operating expenses debited should be removed, as well as non-operating income should also be removed. This will be added, this will be subtracted. In your P&L account, building let out temporarily, 1 lakh rupees debit means credited. Because of that, you spend around 1,000 or 15,000 rupees, 15 or 20,000 rupees. Expenses related to the let out debited here. These two are not considered for your business operations. You started the business for some other reasons. Earlier, we had the center in the other place. Okay, that's a prime place, so most of the means third party will come for sometimes to occupy this for extra consideration. When the class is not operated, usually we let out that property also for additional revenue. Singar Academy is not started for letting out and earning the income. But anyhow, we have the resources we are generating. I need to calculate the cash only because of the operations, not because of this reason. So you have to remove those things. So whatever the value I get here is called cash trading profit. This is called cash trading profit. Not only this, I sell for rupees 1 lakh, but I collected only 80,000 rupees from them, debtors. Remaining 20,000 remains debtors. So I showed the value being 1 lakh in the credit side, sales side. But original collection is only 80, means you have to reduce 20,000 rate. So your cash available will be lesser. It means if the current asset is increasing, your cash balance is locked there. Similarly, if the current liability decreasing, you might have settled your cash is also be applied. These two are going to be subtracted. Then what could be added here? Decrease in current asset as well as increase in current liabilities should be added here. After that, whatever the value you get here, you know, cash from operation before tax minus tax paid. After this tax payment, whatever the value you get here is called cash from operation after tax. Hope now you'll be able to understand this one. Rather than working this way, we can work out this way here to get the answer easily. Okay, clear? And this will be more logical. It's a reconciliation, like you show that profit being 1 lakh. Then if I question you, is that entire 1 lakh is available in the form of cash? No, sir. Why? Give me the reconciliation that cash from operations, the reconciliation statement here. From the 1 lakh, what's the cash I have can be seen easily from this one is, okay, from this statement. Clear? This will be the most suitable. As I already told you in the last class I discussed, right? A person who earns 1 lakh rupees salary per month, another person who earns 15,000 rupees per month. The person who earns 15,000 rupees every month spends around 12,000 rupees always. He gets surplus by the end of month around 3,000 rupees. The person who earns 1 lakh, you know, has the EMI itself 1 lakh 15,000. Now, how can you say who is having the quality of life? A comfortable quality of life. This fellow always thinks about the settlement. But this fellow, the person who earns 15,000, will be leisurely spending his life. So we need to understand not the salary, what's the cash surplus he has in his hand. Similarly, when I want to invest in the business, it's not about net profit, it's all about the cash I get ultimately because of the operations. That's why it's called cash from operation. Hope you'll be now able to understand this. Clear? So here I have given the entire format. Entire format I have given here. Okay. So net profit for the year, non-cash, non-operating items are added and subtracted. Decrease in current assets, increase in current liabilities added, and increase in current assets and decrease in current liabilities subtracted. Then cash from operation before tax, and then you can subtract the tax to get the cash from operation after tax. And related to the cash from investing and financing, add up all the three, and from that you add the opening balance to get the closing balance. See, it is better to have the knowledge about all the assets and liabilities account here. So you need to understand how should be the fixed assets. Asset always having the debit balance in the beginning, credit balance in the end. Similarly, if the asset value increases, it should be debited. If the asset value decreases, it should be credited. Hope you will be now able to understand. With the opening balance, add the amount for the purchases and profit on sale. These are the items increasing the value of the assets. Sales, profit, loss on sale as well as depreciation will reduce the value of the assets. That's a simple asset account. Very often I tell the students to go and study the fundamentals of accounts. Okay, depreciation chapter, where we have all this calculation in depreciation chapter. Similarly, here from the original value we have subtracted the depreciation. In another model, from the original value, depreciation will be shown separately in another account. Accumulated depreciation model. So you have to understand these two models. Sometimes you need to apply this one for working note. Sometimes you need to follow this model for the working note. Because all the details not given directly, you have to open the concerned ledger account to get the some missing data. From that you can find out if there is any bank here. Okay, this one only will go to the cash from financing or investing, cash flow statement. Here, this bank will go. Okay, you have to be careful. How can you consider the cash balance or non-cash and other items and all here one after one? So this is the logic you have to understand. So anyhow, I've given the format here. You can have the go through of this so that you will be able to understand easily. Now let's start with the question number 2 here. Okay, question number 2. Balance sheet is very important. From there only you have to start. In balance sheet, non-current asset is given in schedule. Right, in schedule. Let's see. What about this income statement, sir? Usually income statement is not required. But income statement is the clue for getting some adjustment. What are the adjustments you have to consider from the income statement? Is there any non-cash, non-operating items are there? Then you have to remove that from there. Those things are adjustments. Depreciation, non-cash. Salaries and wages, never bother about that. Operating expenses, never bother about that. Provision for depreciation, taxation. Provision for taxation in the P&L account is usually creation of provision, not actual payment. Actual payment may be different. So it's also non-cash item. You have to understand this is being the non-cash item. Two things. And non-recurring income, profit on sale of equipment. Profit on sale of equipment related to your investing activities, not here. So it's not operating activity. Retained earnings and profits brought forward from the previous year. Retained earnings and profits brought forward from the earlier year. Okay. Opening profit. And dividend declared and paid during the year. Dividend declared and paid during the year represents cash from financing. So this is cash from financing item. This is cash from investing item. This will be non-cash item. But tax paid is the means operating item. Okay. And depreciation non-cash item. Here, original cost of equipment sold during the year was 720. only one of the assets sold. Original cost being 720, but here profit is the 120. Original cost 720. Accumulated depreciation on that, I am not aware about that, subtracted. Balance will be the WDV value. Balance will be the WDV value. In that WDV value, you have to segregate into two forms. How much we get here? Original cost of the equipment 720. Okay. I'm not sure at what rate we sold it, but one thing is pretty sure. We earned a profit here. So profit on sale, which is 120. So now this information missing, this information missing. Unless you know the accumulated depreciation, you cannot find out the WD value, or you need to find out what is the sale value at least. Nothing is given. In this case, you have to find out all these things as a missing data by opening that concerned ledger account. You have to open the asset account as well as accumulated depreciation account so that you will get the other thing easily. Right, let's now start. Let's now start. Yeah, you can join with me to solve this. I'll post all these things here itself. Now, what's that? Cash flow statement, cash from operation. I have to start. Net profit first will start. Cash from investing, cash from financing, cash from operation, cash from investing, cash from financing. With that, opening cash balance should be added to get the closing cash balance. And we better have the working notes to be prepared separately. Okay. Now I'll start with what? Balance sheet. Asset side items will be posted first. Asset side item. In the asset side, non-current asset given in schedule number 1. So I'll pick that here. Non-current asset. We'll start one after one. No information related to the land. 480 becomes 960 matter of 1 year later. What does it mean? Increase of asset is nothing but maybe purchases. Probably it has no depreciation usually. So directly post that value. Increase in land or land purchases. Is it inflow or outflow? So outflow of cash. Land purchased. 480 purchase. So the value should be in the brackets. Building and equipment, we have the adjustments. It's better to prepare that separately. Building and equipment. And we have accumulated depreciation on that. So you have to open that one also separately. Accumulated depreciation. Okay. Opening and closing value of the building being opening balance 3,600. Closing balance being 5,760. Accumulated depreciation on this in the beginning, opening balance 1,200. You have to take the original value only because its accumulated depreciation will be opened separately. Closing balance here 1,320. 1,320. Clear? Now, Schedule 1 related to non-current assets posted already. Inventory. What happens here? Inventory value decreases. Decreases means cash realized. Okay. So I will have first part net profit and related to the non-cash and non-operating items. Second part is for the current assets and current liabilities. Second part, changes in current working capital. Okay, current assets and current liabilities. Under that, decrease in inventory. How much? 1,680. Inflow. Trade receivables. Increase in debtors. Increase in debtors by 180 negative. Money has been locked. Cash and cash equivalents. Cash and cash equivalents. In the beginning, we have 600 rupees opening and closing being 720. So from this, it is very clear. Cash from operation, investing, financing, both put together should be 120. Okay, you can guess this. What about the advances? Maybe expenses paid in advance, like 78 increases to 90. You have paid advance additionally. Your money has gone out. So increase in advances. Increase in advances. The value being 12 rupees outflow of cash. So I have posted all the items given in the assets. Next, let's move on to the liability side also. In the liability side, these are the items. Now, share capital increases from 3,600 to 4,440. Maybe issue. There is no any adjustment, we have not seen. So issue of equity share capital will be a receipt. How much is that? 840. Reserves and surplus, the difference between opening and closing, assumed to be the income earned in the current year transferred to the P&L. How much is that? 120. This is 120. And related to the current liabilities, trade payable 2,400 becomes 2,340. Decrease in trade payables or creditors. How this decreases? You might have paid, so it's an outflow of cash. How much is that? 60 rupees being the negative value. Other current liabilities. Outstanding expenses 240 and 480. Increase outstanding expenses. Increase related to inflow of cash. The value being 240. 240 being inflow of cash. Short-term provision. Okay. Short-term provision in this case being 120 in the beginning, end being 132. I may open an account for this provision for taxation. As it is being the liability, opening value should be in the credit side. Closing value should be in the debit side. 132. Hope now you'll be able to understand this one. It's getting closed. Clear? Now pick the adjustments already marked. What are the adjustments we already marked? Depreciation. Depreciation 600 is what? Depreciation for the non-current assets calculated for the current year only. You understand? For all the assets put together, the current year depreciation being 600. If we have the accumulated depreciation, that will be shown in the credit side here. Very, very important. Very, very important. And this adjustment I am going to incorporate. Original value of the asset 720. Accumulated depreciation on the asset sold. After subtracting, this is the WD value. Sold and the cash realized, but we are sure that there is a profit on sale. The profit on sale in this case being 120. Now, you have to understand how to open the assets account along with the accumulated depreciation model. Under this model, the depreciation on the assets sold usually available in the accumulated depreciation no more required is transferred from accumulated depreciation to asset account. From here to here it should be transferred. Is that okay? 1800 rupees. Year beginning we have 1200. Current year depreciation for all the assets we have being 600, overall 1800. But the year end we came to know we have only 1320. So naturally 480 rupees is missing. That 480 is nothing but what? Depreciation on assets sold. Okay. Unless you have this particular working note knowledge, you will be struggling here. So go and see those videos also already. So accumulated depreciation or depreciation on the assets sold 480. This value is going to be recorded here. Hope you got this value. 720, the assets sold for some, I'm not sure at what rate it sold, but we came to know there's a profit of 120. Original value being 720, accumulated depreciation on this being 480 is going to be subtracted here to find out the WD value. The 480 is calculated by preparing these two adjustments, building and equipment as well as accumulated depreciation. If we have not prepared, then we are not able to get this value. From 720, if I subtract 480, what is the value I have? 240. Sold for a profit means sale value should be 360. Is that okay? You have to understand. Unless you sell higher than the WD value, you will not make the profit. So I am going to record all these things here. Bank. Sale value being 360 and profit on sale 120. Whatever the thing you record, it should be posted twice. 360 should be posted where? Sale of building. Cash from investing, the value being 360. And this profit on sale credited in the P&L account, but what is that? Non-operating item. If you are removing, then the profit will decrease. So minus profit on sale. Profit on sale. Non-operating item. So I am removing this 120 rupees is removed. You get 120 rupees additional profit only because of profit on sale, but selling your asset is not your intention or your operations. So I posted twice. Then this one is over. Let's go for the provision for taxation, 880. Already we have the provision in the beginning, 120. In this year, further provision created 880. 1000 rupees. But year end, we have only 132. 1000 becomes 132 means the difference may be paid bank. How much is that? 868. Usually you create the provision for the taxation. If there is a shortage, additional provision also be created. From that the payment will be finished, and for the next years also we create the provisions. Initially what we have is usually paid. Closing balance is created. That's a logic. If there is a shortage, if it is not mismatching, okay. Here it's mismatching. Mismatching means the amount debited to the P&L account as well as bank account will be totally different. In this case, opening plus current year additional creation will be the payment. 868 paid, will be subtracted here. Cash from operation before tax minus tax paid. How much tax paid? 868 is paid. After that, what you will get? Cash from operation after tax. This one is recorded. What about this 880, sir? This 880 is nothing but amount debited to the P&L account, non-cash item, because only debited, not paid. non-cash item. Non-cash item debited reduces the profit, but cash has not gone out, so you have to add back. So add provision for taxation. Always remember the provision for taxation is added and at the end actual payment is subtracted. Same logic will be applicable in case of dividend. Provision for proposed dividend is debited in the P&L account, but it is not operating expenses, so you have to add back. And don't forget to subtract this or minus item in the cash from financing. Cash from financing. Okay, here provision for taxation in this case being 880. Double entry over. Double entry over. Clear? So we have done all these things. This one is over. This one is over. This one is over. Dividend declared and paid. So dividend declared is debited to the P&L account, but it is not your operating expenses. So add back. Dividend declared. Dividend declared. How much is that? 720. And it should be forming part of what? Financing item. So I am going to subtract here. Dividend paid. Dividend paid here being 720. Whatever the treatment I do for the taxation is similar to the dividend also. But in case of taxation, provision added, payment subtracted. In case of dividend, proposed is added, payment is subtracted, but not here. It will be in the financing aspect. Okay. Yes. I have completed all these things. Come on, finish up tallying this. What about the building and equipment? If I tally 6,600, 2,880, I am getting the balance. Bank purchases. Building and equipment. So, purchase of building. Investing activity. Purchase of building. What are the balance you will get? No, again it will be transferable somewhere. Okay. So, here as it is being the asset investing activity, I posted that value here. Then this depreciation, current year depreciation. Add the depreciation back. Now, if I do all the addition and subtraction, cash from operation before tax should be 3,868. If I subtract the tax paid, 3,000 will be the cash from operation after tax. Cash from investing, you get 3,000 rupees negative and you get 120 rupees positive. 3,000 positive, 3,000 negative, 0, then 120 positive. The summation will be this value. Is that clear? Hope now you'll be able to understand the cash flow statement easily. Come on, make a note of it. Now, question number 3. See, in this illustration, you know, I started with net profit 120. I started the net profit with 120. Then what is the net profit given in the profit and loss account? 1,638. Subtract the brought forward profit. If you subtract, then what is the current year profit? 120. Okay. Sometimes you may start with 840. You adjust the dividend declared and paid from here. Then 120. That's how you can work out. We'll see the next illustration how sometimes the profit given in the P&L account is taken instead of the difference between the opening and closing profits. Question number 3. See, this sum runs through almost 3 pages. So whenever you try to solve any illustration for the cash from operation, cash flow statement, directly go and see the adjustments and verify whether the assets are given at WD value or accumulated depreciation model. Only keeping this idea, that's more than enough to solve this. Yes, come on. Now, yes, cash flow statement. First is all about cash from operation. Second, cash from investing. Third, cash from financing. Cash from operation, cash from investing, cash from financing. With that, if you add opening cash balance, you will get closing cash. Clear? I start with assets to be posted. In these assets, we have been given two schedules, schedule number 3 and 4. 3 and 4. Yes. What we can do? We can open all the ledger accounts. Simply we open all the ledger accounts. If there is no any adjustments for any of the assets, you simply directly see the differences post in the cash flow statement. Else you can safeguard yourself by preparing all the ledger accounts. So here, land. What's the opening value and closing value for the land? Opening balance OB 100, closing balance also 100. We may assume that there is no any adjustment, there is no change, there is no any inflow or outflow. In this case, you can simply skip opening this ledger account at all. You no need to open. Anyhow, I just open for better understanding, for uniformity. Building. Building being the asset, opening balance should be in the debit side. The value being 400 and closing balance should be in the credit side. 380. Machinery. Opening balance should be in the debit side. 750. Closing balance here 920. And cash in hand and bank, you can put the value in total. Opening cash balance being cash and bank both put together will be posted here. Cash, bank and marketable securities and all. Closing being 575. So the cash from operation, investing and financing should be 75. Okay. If you add the 500 with 75, you need to get 575. Definitely the summation of these three should be 75 rupees. Right. Now here, property, plant, equipment, and we have been given long-term investment. This is over. Long-term investment. Long-term investment. Opening balance should be in the debit side. Value 100. Closing balance 50. And in case of inventory, 500 rupees becomes 280. Decrease in inventory. If the stock or current asset decreases, inflow of cash. It may be assumed cash realized like. And trade receivables or debtors increases, your money is locked outside, negative value. Cash and cash equivalents were already posted. Clear? We have posted the asset side items. Move on to the liability side items. Schedule number 1 and 2 we can post it later. So we have been given the share capital. No schedule, so open it separately here. No share capital. Opening balance, as it is being the liabilities, opening should be in the credit side, closing should be in the debit side. Opening balance 1000 and closing balance should be 1250. 1250. And in case of reserves and surplus, we have to refer the schedule number 1. It may have lots of details. I'll do it later. Non-current liabilities, debentures. Initially we have 500 rupees. Year end we have 400 rupees. Under current liabilities, trade payables, we have to pick it from schedule number 2. Other current liabilities, proposed dividend and provision for taxation. In case of proposed dividend and provision for taxation, okay, you can better open the concerned ledger account like opening balance 100, closing balance 125. Similarly, short-term provisions, provision for taxation, opening balance 50, closing balance 60. Clear? Go to the schedule number 1 and 2. From this item, creditors decreases, decrease in creditors. If the current liability decreases, we might have paid, so outflow of fund. Bills payable increases, your money is with you only, 100 rupees inflow. Schedule number 2 is completed. Now we have the capital reserve. Capital reserve, in the opening we don't have any balance. Closing balance being 10. General reserve account also be open. Instead of opening, I may post directly. 250 in the year beginning becomes 300. What does it mean? Amount transferred to GR from the P&L account. As the amount transferred from the P&L account to GR, it's a non-cash item. Okay, non-cash item. Is that okay? Because of transferring, there is no any amount affected in the cash. So, net profit for the period being the difference between opening and closing 150, 180, 30. In the P&L account debit side, we might have debited for transfer to the GR. It reduces the profit, but actually it will not reduce the cash. So add back. Very simple. The non-cash expenses, non-operating expenses debited, all the debit side items are added back. So amount transferable to the GR is in the debit side, should be added back. Any other amount usually added in the P&L account can be simply added here. So here, transfer to GR. This value being the difference between these two 50. So the given item in the balance sheet is now posted completely. Let's now go for the adjustments. This is no more required for me. 2 pages complete. So if you are able to do this, then half tension is over. Only 8 adjustments are there, or 8 one more question like. Okay. If it is 16 marks, for 8 adjustments, 8 marks. Initial record what we have done now for 4 mark, and final answer being another 4 mark. Very simple. Dividend of rupees 100 was paid during the year ended. In this case, we proposed to dividend 100 rupees in the previous year, usually may be paid in this year bank. Current year closing balance may be created by debiting to the P&L account. Should be posted twice. This 100 rupees payment is for financing activity, so dividend paid. Dividend paid. 100 rupees negative. This amount debited in the P&L account not related to the cash transaction. So it may debited means it should be added back. So here proposed dividend. Very simple. Any items debited in the P&L account added, any amount, any items credited will be subtracted. That's how you can understand the logics. So 125. So working note number 1 over. Adjustment number 1 over. Machinery during the year purchased 125. Machinery. In case purchase machinery to bank 125. Double entry. In bank, cash from investing, machinery purchased 125. Outflow of cash. Machinery purchase. Outflow of cash. Machinery was purchased for a consideration 100 payable in equity shares. Another machinery purchased, for that the payment is in the form of equity shares. So 100 rupees machinery. Machinery account debit. The payment is not in the form of bank but in the form of equity share capital. So equity share capital. Automatically the next entry will go to the equity share capital. Here equity share issued for the purchase of machinery. So any transaction will not be converted into cash, then it is not cash flow statement. It's not a part of a cash flow statement item of a cash flow statement. So it will not come under cash flow statement. Income tax provided during the year 55. How much income tax provided in this year? Amount debited to the P&L account is 55 here. And on tallying this, the difference between these two 45 may be payment. Hope you will be now able to understand balancing. If nothing stated, usually you know, opening may be paid, closing may be created like the earlier one. But if there is slight number variation, you can work out this way. This P&L account debited, right? So added here. Proposed provision for taxation. How much is that? 55. And in bank also we have, will be posted here. Tax paid. Tax paid. The value being 45. After subtracting the tax paid, the value what you get is nothing but cash from operation in net. Or you can name this being cash from operation after tax. Beforehand, we have cash from operation before tax. Now, 51. Company sold some investment at a profit, which was credited to the capital reserve. So, some investment sold, we are not aware about what is the cost of investment sold, but because of the sales, there is a profit. That profit is available in the capital reserve. In your capital reserve, you have 10 rupees as closing balance. Maybe because of profit on sale of investment. Usually, profit on sale of any asset is transferred to the P&L account credit side. Here, this profit is credited in the CR account. And then the CR, initially we have no balance and later we have 10 rupees balance, means the increase in credit means capital reserve is due to the profit on sale of investment. Then parallelly, profit will increase the assets value. So I put that value in the debit side. And here CR, which is nothing but profit on sale. Profit on sale. Double entry over. CR account got tallied. Provision for taxation tallied. Proposed dividend also tallied. There was no sale of machinery during the year. There is no sale of any machinery. As the information regarding the machinery sale is not available and clearly stated not there, if you tally what you get, 975, 975, 55 rupees value decreases here. Usually decrease the value of the asset is due to what? Usually depreciation, another one is sale, but sale is not there, then definitely it should be depreciation. Depreciation is the amount debited to the P&L account related to non-cash. Any amount debited will be added here. So depreciation on machinery. Double entry, or once you get any balance should be posted immediately to another place. Building costing 150, WDV 70, sold for 60, and 10 rupees you get less, then it's called loss. And there is purchase also available, building related. And there is a depreciation for building also, 20 rupees. I'll finish off building depreciation first of all. Depreciation reduces the value of the asset, this value being 20, and debited to the P&L account. So here building depreciation 20, and sold for 60 and loss 10. Sale and loss reduces the value of the asset, so I put the value in the credit side. So bank, I get 60, loss on sale value rupees 10. Depreciation posted twice, here and here. Loss should also be posted twice. Usually loss is available in the debit side of P&L account. Any item in the debit side is added back, like you can understand very easily. So loss on sale, loss on sale of asset, 10 rupees, and 60 rupees you receive no cash from investing, building sold, you receive the money. Bank means it will go to the cash flow statement. And we have completed this one, and there's a purchases also. If you tally this, 470 you are getting, so 70 rupees may be purchases bank. Asset increase is due to purchase, will be posted in the cash from investing, building purchased. Sale is inflow, purchase is outflow. So building over, machinery over, land no adjustments, no purchases, no sales, no depreciation, no revaluation. In case of long-term investment, 110, closing value 50, 60 rupees will be sale. We are pretty sure there's some value of asset, investment is sold by making a profit transfer to the CR, so profit is 10. Then the sale price is 60, means the cost of investment sold may be 50 rupees. Initially we have 100 rupees, out of that 50 rupees worth the investment sold for 60, remaining 50 remains as an outstanding. The sale being part of cash from investing. So sale of investment sale, 60. CR, okay, everything is okay. So in case of debenture, 500 becomes 400, what does it mean? 100 rupees may be redemption, may be repaid. Non-current liabilities as well as share capital change will be a financing item, so I will put the value here. Decrease in debenture or redemption of debenture. For that, there will be outflow of rupees 100. In case of equity share capital, 100 rupees equity share issued for purchasing the machinery. Still, one more 150 balance is there, may be issue for cash. This is nothing but cash from financing, sale of issue of equity shares, issue of equity share capital. This value being 150. Yes. Come on, find out the cash from operation before tax. I think 245. Tax paid is subtracted. Cash from operation 200. Cash from investing 75 negative. Cash from financing 50 negative. 50 negative, 75 negative, 200 positive ends with 75 positive. With that, opening cash is added to get the final closing balance. Hope you will be now able to understand this. Usually, up to this, you may name this being cash trading profit. Okay. Are you getting this value? Yeah. We'll now move on to the question number 4. Here, the assets are given under provision for depreciation model like third working note, third note. And similarly, we have been given the additional information. Come on, open the formats here as usual. Now, cash flow statement. Number 1, cash from operation. Number 2, cash from investing. Number 3, cash from financing. Adding number 1, number 2, number 3. With that, if you add opening cash balance, you will get the closing cash. You will get the closing cash. Let me finish up the notes to accounts first in this time. Okay. I'll pick first 2 notes. GR 250 becomes 300 due to the transfer, can be debited with the net profit here, transfer to GR, value being 50. Profit and loss 700 becomes 190, then there is a loss of 510. 510 being loss. Trade creditors 300 becomes 250, decrease in creditors. If the creditors balance decreases, you might have paid, so minus item. Bills payable increases, money is with you or not settled, so you have the money in your hand. So I have completed the schedule number 1 and 2. Finish of posting all these things faster like this. Okay. And schedule number 3. Schedule number 3. Land has no depreciation, but initial value 100 becomes 600. What does it mean? Maybe purchases. Cross verify if there is any adjustments for the land. No. Okay, we don't have any adjustments, so we assume currently the difference between these two is nothing but purchase of land. Purchase of land is cash from investing, value being 500 rupees, outflow of cash. And then we have building machinery. So building and its accumulated depreciation, provision for depreciation for the building. Okay. Opening value being 650, closing balance being 570. Accumulated depreciation on this opening balance 250 and 190. Okay. Hereafter, the sum seems to be a normal single entry like normal single entry like. You are preparing the cash account. That's all. Cash book. While preparing the cash book, cash from operation only will be different. Indirect method. Okay. Next one being machinery. Opening balance of the machinery being 1000, closing balance 1220. Okay. What's the closing balance? 1220. Provision for depreciation on this. Opening balance 250. Closing balance 300. So we have completed the schedule number 3. Now 4 and 5. Schedule 4 and 5. See, when there is provision for doubtful debts, skip it and take the balance only 400 and 220. So decrease in debtors. Decrease in debtors is nothing but you encashed it. So you are getting the money. What is the value? 180, you get this money. Cash in hand and bank 200 plus 300, 500 in the beginning. 165, 110, 275 in the end. So 225 should be the negative by summing up of the three flows: operation, investing, and financing. I have given the treatment for the bad debt, provision for doubtful debt separately in the text. If you want, go and see that. But of course, for your examination, not to pay. So this one is completely over. Now here, I'll start with asset side value. In asset side value, property, plant, equipment, schedule number 3. It comprises 3 assets we already posted, and we have non-current assets, non-current investment. Opening balance 100, closing balance 50. Inventories 300 becomes 280, decrease of stock. The value decrease being 20. If the stock decreases, it may be assumed our cash balance increased due to this. Okay, due to this. So we have posted all these items. Let's go for the liability side items. Now share capital 600 becomes 1250. 600 becomes 1250. We assume this increase is due to the fresh issue. You no need to open the ledger directly. You can post that in the financing, or you can open the ledger and wait for any adjustments. Okay, I think we don't have any adjustments. Because of that assumption, I may directly post here issue of equity shares. How much is that? 650. Inflow of cash. Reserves and surplus, schedule number 1 already posted. Non-current liabilities, debenture 500 becomes 400. There is an adjustment, so you better open the concern account, debenture account. As it's being the liability, opening balance should be in the credit side, 500, and closing balance should be in the debit side, 400. Trade payables recorded. We have been given proposed dividend and provision for taxation. Proposed dividend, provision for taxation. So, opening balance 100 and closing balance 125. Here, opening balance taxation 50, closing balance 60. Okay. So, I have completed posting this one. See, recording all these things this way, it's very simple. Matter of 2 or 3 minutes you have to take. Within that time, you have to finish off. Now you can incorporate the adjustments here one after one. Company sold some investment at a loss of rupees 10. Okay, investment sold. 100 rupees investment becomes 50. 50 rupees missing means that may be sold, but while selling, we lost another 10. So the amount collected being only 40. Another 10 being loss on sale. Loss on sale. Is that okay? 100 becomes 50 means 50 rupees sold. While selling, we lost 10 means 40 rupees will be the amount recoverable. So here, sale of investment, non-current investment, 40, and loss on sale debited to the P&L account, addable here. Loss on sale of investment, the value being 10. The value being 10. There was no sale of machinery during the year. No sale in machinery. So 1000 becomes 1220. No sales means purchases will be there. 220. Bank. Investing angle. Okay. Purchase of machinery. Sir, what about the depreciation, sir? That will be separately dealt. Only whenever any of the assets sold, the accumulated depreciation on the asset sold will be transferable from the provisions to asset account. Here, 250 becomes 300. That increase 50 is nothing but the depreciation for the machinery in this current year, debited to the P&L account. So here, depreciation provision for machinery 50. This one over, this one over, this one over. Building costing 150, WDV being 70. What does it mean? The accumulated depreciation on this from the date of purchase to the date of sale being 80 was sold for 100 and you got around 30 rupees excess, so this will be called as your profit. Also, we have the purchases of. I am not aware about what is a purchase amount. I can incorporate all this value here. Under what model? Provision model. The depreciation on the asset sold from the date of purchase to the date of sale should be transferable from provision for depreciation to building account as per this model. How much is that? 80 rupees. You have to be careful here. Depreciation, provision for depreciation on the asset sold. Here, building account. The depreciation for the asset sold since the date of purchase to the date of sale. Sale value, bank, you collect this money. 100. This 80 posted twice. 100 to be posted again. Where? Here. Sale of building. Huh? Okay, okay. Sale of building being 100, and there is a profit 30 rupees. Profit increases the value of building 30. Profit is usually credited in the P&L account, right? So subtracting item. Profit on sale. Profit on sale. The value being 30 minus item. Also, this includes some profits also. Okay, by telling this, what happens here? Some purchases also we have. So bank, you have to find out the balancing figure. 750, 750, 70 rupees is purchases. Purchase of building. Purchase of building. This value being 70. Outflow of cash. And if I tally the provision for depreciation, 270, 270, 20 rupees is nothing but the depreciation for the asset we have this time. Usually debited to the P&L account here, building. This value being 20. Debentures are redeemed at a premium of 10%. So 500 becomes 400, 100 rupees debenture redeemed. While paying it back, we paid 10 rupees excess. The original payment for this being 110 bank. The additional payment is our loss here, premium on redemption. The loss is usually debited to the P&L account, so I'll post that value here, premium on redemption. This value being 10 rupees. And 110 you are getting the money, so paying the money, redemption of debenture. Redemption of debenture. This value being 110. So 510, 510 tally. Proposed dividend and provision for taxation are considered as non-current liabilities. Non-current liabilities, what we have done is called non-current liabilities. If it is being the current liabilities, the difference is directly posted here. If you are preparing separately, then it is called non-current model. If nothing stated, opening may be paid, closing created in this year. Paid, created here. In P&L account, we have debited what? Proposed dividend, value being 100. Provision for taxation, value being 60. Oh, 125. This is 125. This will be 60. And tax payment, cash from operation before tax minus tax. How much tax is paid? 50 rupees. Cash from operation. And how much dividend paid? 100 rupees. Dividend paid 100 rupees. Apart from that, interim dividend 50 also paid. Interim dividend also debited to the P&L account and then payment is made. So interim dividend paid 50 rupees. And here interim dividend paid 50 rupees. Redemption of debenture also outflow of cash. This last adjustment, provision for doubtful debts can be removed, can be skipped. Yes, come on. Tally and find out the cash from operations here. $85 before, after 35. Cash from investing 650 negative. Cash from financing 390 positive. 390 positive, 35 positive, 425, 650 negative, 225 ultimately negative you are getting. Hope you will be now able to understand this one. This question 5 is also a variant of the earlier illustration. Here, non-current liabilities being 10% debentures, in share capital 12% preference share capital. These two are hidden adjustments. Then there may be preference dividend payment. Here there may be interest payment. The interest payment for the debenture debited to the P&L account, but actually it's a financing item. It should be posted in the cash from financing. Same way, the dividend should also be transferable to the cash from financing. Hidden items. Hidden adjustments for interest on debenture and preferred dividend. So rest will be the same, like you can guess and finish up easily. And I skip the bad debt. Okay, bad debt provisions will be skipped. Eighth one, stock which was valued at 290 on this was written up to cost 300. So 2020 we valued at 290, thereafter it is revised as 300. Here itself we have shown the revised value. The revised value included in the profit also. So no need to do any adjustments. So you forget about this one. You forget about this one. Sometimes you need to adjust, but here not required. Everything is proper. Prepare sale of investment. Profit on sale of investment was credited in capital reserve. The capital reserve's profit is due to profit on sale of investment. Profit on sale of investment. I finish up the adjustments. Proposed dividend and provision for taxations were considered as current liabilities. Current liabilities means the treatment of current liabilities can be followed here. If the current liability increases, then your money is released. Okay, cash is inflow. Cash being in your hand. That's how you can work out. Treat like current liabilities. But it's very rare. Most of the cases you will treat this being non-current only. But in case if you treat this being current liabilities, how? So we'll try to understand that one also, but very rare. Earlier one you can follow. Okay. Profit on sale. Okay. Then investment consisted of shares in another company where purchased and dividends amounting to ₹10 declared out of profits made prior to the purchase was received. Okay, this was written down the investment. So you get the dividend and all from pre-acquisition profit, post-acquisition profit. If you are receiving the dividend from pre-acquisition profit, then the entry being bank account debit to investment means you have to credit the investment and reduce the investment. If you are getting this from post-acquisition profit, then it is normal profit can be transferable to the P&L account, like dividend, and this dividend is ultimately transferable to the P&L account. Then what is called pre-acquisition, post-acquisition? Let's see. A purchases the debentures from XYZ Limited, debenture or shares, whatever it may be, and paid 105 rupees on 1/1/2026. On 2/1/2026, 10 rupees dividend paid. Dividend 10 rupees paid. How will it be possible? Within one day, how the interest could be, how the dividend could be payable. It means XYZ Limited already generated the profit and kept undistributed, and A knows that he demands to purchase the share, so he purchased the share. Similarly, the seller of this company shareholder will say, "Sir, there is huge profit accumulated, in a matter of 1 or 2 days later, you will get the dividend. So give me the share price, the face value 100 plus the accumulated dividend also." So the 105 A paid after considering that there is a chance of getting 10 rupees immediately. So while paying, the journal entry being investment account debit to bank, the payment being 105, 105. And matter of a day later, if he receives, it's nothing but the investment is returned back. So the entry being bank to investment. Bank to investment. Thereafter, the investment value being only 95 in your books. But instead of 2/1/25, it is 2/1/2026. Okay, this is 26, it's 27. Okay, you invested and waited for one full year. That investment is used for generating the income, and from that income, dividend is distributed. This is nothing but return on investment. Your investment yields this money, it's your profit, can be transferred to the P&L account. Without you waiting, if you are getting any benefit, this is nothing but the amount is already paid in along with the consideration. So the amount receivable is subtracted from the such a cost of acquisition only. Clear? So investment consists of shares in other company where purchase and dividend amounting 10 declared out of profits made prior to the purchase. Should be written down the investment value. Okay, investment. Here, pre-acquisition dividend. How much? 10 rupees. Then depreciation for building and machinery were 50 and 70. Building and machinery. Depreciation being 50 and 70. Preference shares were issued at 10% premium at the end of the year. Preference share. Issue at end. At end. Debentures were redeemed at 10% premium at the end of the year. Redeem at the end. So hereafter, I never bother about the adjustments to be incorporated later. So while posting itself, I can finish up posting after this adjustment. Let's start with the working notes. These are the items. Come on, open all the requisite ledgers and statements. Cash flow statement. Cash from operations, cash from investing, cash from financing. Add 1, 2, 3, add opening cash, you get closing cash. I'll start with schedules number 1 and 2. Equity share capital. So no adjustments. Then change in equity capital is due to issues. So issue of equity shares. the value being 250. 12% preference share capital. As we have adjustment, I may open separately. Opening balance 400. Closing balance 500. Highlight this 12 percentage. What's that? Hidden adjustments. 12% preference dividend may be paid. The fresh issue made at the end, so the preference dividend will be available only for the opening balance. For 400, 12% 48 rupees. So I'll put the value here, net profit, dividend for preference share capital. How much is it? 48 rupees. Okay, okay. So opening balance 400 and closing balance 500. 48 being dividend, I post that value here. Dividend for preference share. Hidden adjustment. GR initially 250 and issue is also no. We can put that value also here. Bank. Issue of equity share, preference share capital. 100 rupees. Dividend is outflow. GR 250 becomes 300. Transferred to GR. Debited in the P&L account is now added back 50. Profit and loss 150 becomes 190. 40 rupees is the profit in the current year added with the opening to arrive the closing balance. Securities premium 10 rupees. Then preference share may be issued at premium. You collected 110 and difference being securities premium. I missed to incorporate this 10%. Okay. So here 110. We collected 110. Another 10 rupees is adjusted here. So you no need to reopen the securities premium account. Revaluation reserve land. As there is a revaluation reserve of land, this will be only due to the revaluation reserve. You can now skip this. You can skip this one as well as you can skip this one also. You no need to worry about this. Capital reserve 10 rupees is due to profit on sale of investment, non-current investment. Opening balance debit side. Opening balance debit side. Closing balance credit side. Profit gives a rise to non-current investment. 10 rupees. And this is transferred to CR account. So nowhere it will come cross checked and cancel with the CR account here. Okay, this one is over. Schedule number 1 and 2 over. Schedule number 3 is all about trade payables. Trade creditors decreases. If decreases, you might have paid so outflow of cash. Increase in bills payable, cash is in your hand, so plus item. Now, in assets, land is not required to be incorporated, only building and machinery are going to be incorporated. I open the building account. And machinery account. Opening balance 400. Closing balance 500. Machinery opening balance 750, closing balance 920. Depreciation on building 50, machinery depreciation 70. Should be posted twice. The depreciation will go to the P&L account debit side. So here it is going to be added. Depreciation on building 50, on machinery 70. We'll now go for trade receivables and cash equivalents. Trade receivables, debtors, increase in debtors, so your money is locked. Cash and cash equivalents 200 plus 300, 500 in the beginning, 165 plus 410, 575 in the end. 75 is due to the three reasons. Is that okay? So we have completed all the schedules and adjustments. Leftover items. This one is over. This one is over. Debenture 500 and 400. 10% debenture redeemed at the end. 10% debentures. Initially we have 500, year end 400. So this 10% represents hidden adjustments and redeemed at the end. The redemption happened only at the end. So 100 bank. Redemption of preferred debentures. Redemption of debentures. 100 rupees outflow of cash. This one over. And these two are considered as current liabilities. But in Singar Academy text, I consider with the traditional one, non-current like. Predominantly, you will consider this being non-current. If you consider current like, how this will be treated? Very simple. Like current account, current liabilities, you can show here also. Proposed dividend increases. But this one is very rare, so 25. Proposed dividend increases means your money is with you, you have not paid. And increase in provision for taxation. 10 rupees. Also money is with you. Money is with you. Oh, okay. Increase should be addable item. Okay. Money is with you only. Usually you will add and subtract from the cash from operation as well as cash from financing. If it is not so, this is the other method. Okay. But I have not solved this way in the text. In the text, I have solved the other way. Okay, non-current like. Over. This is also over. Non-current investment 150. Non-current investment. Initially we have 100, year end we have 50. And where 10 rupees is out of pre-acquisition profit. If you are receiving from pre-acquisition profit, it is subtracted from the asset account. Bank account debit to investment value 10. And then the balancing figure 50 is also be sale of any other investment. Okay, don't get confused with this term. Both are bank only. One is we have not sold, but we are receiving the dividend which was declared out of the pre-acquisition profit. Another 50 is sale along with the profit. Probably 40 rupees worth the investment sold for 50. Because of that reason, there is 10 rupees profit. So sale of investment. Sale of investment. Inflow of cash 60. 10 plus 50, 60. Then inventories 300 becomes 280. Decrease in inventory. 20 rupees decreases. Maybe you may have this cash in your hand like. Now finish up telling that 10 percentage, interest may be payable on 500, 10 percentage, 50. Interest on debenture. This interest on debenture debited to the P&L account, but it's not related to the operation, it's related to the financing. Financing fund requirement, for the fund requirement we are paying. So, this interest on debenture should be posted in the cash from financing as outflow of cash. These two are the hidden adjustments. Non-current investment tallied, building 550, 150 increases. What is that? Bank purchases. Purchase of building. This value being 150. Outflow of cash. Machinery 990 and 240 bank. Purchase of machinery 240. Outflow of cash. Everything posted. You don't get the book answer because I have assumed 2 or 3 different items here. So try to find out the cash from operation here. Here we don't have the cash from operation before tax and after tax. Yes, cash from investing. Hmm? 330 negative. Okay. And here 52 positive. And get me this value. Huh? This one is 280. 280 positive or negative? 283. And what about here? $162 positive. 283 plus 162 minus 330. How much you are getting? Huh? 115. You are aware about that number should be 75, right? How much difference you are getting? 40 rupees. Check any round number, anything. Huh? Non-current investment profit. I have shown that in the capital reserve account. Mutually cancel. Check. Debtors increase is what? Outflow of cash. Your money is locked. So naturally you have to reduce 40 here. If the difference is round number 40, check half of the number or double the number anywhere. You can guess it easily. Hope now you'll be able to get the answer. Why don't we get the book answer? Because there the treatment is totally different, especially proposed dividend and provision for taxation both are assumed the other way, and I have incorporated the provision for doubtful debts also in different manner. So you try to understand the provision for doubtful debts separately, the format given in text. Okay, it's very rare, that's why I'm usually not teaching.